Assalamualaikum warahmatullahi wabarakatuh. We are from Group 13 and we would like to present about analysis and interpretation of financial statement of Celcom, Digi and Maxis. So, this is our group members. First, Maithili and second, Nur Erika Adila. Third, Nur Lizati. Fourth, Nur Akilah. Fifth, Nuri Iliana. And the lastly is Syed Nur Kuratoani. So, I will pass to the first presenter, which is Nur Erika Adila, to present about the introduction.
Assalamualaikum, my name is Nur Erika Adila binti Awang. My matrix number is A23P1960. I will briefly compare two key players in Malaysia telecom industry, Celcom Digi Berhad and Maxis Berhad for 2023. Celcom Digi with over 20 million customers focus on innovation and digital solution, while Maxis with 30 million customers emphasize core services like fiber, mobile and enterprise, along with sustainability. We also consider external factors like market competition, regulation and sustainability initiative. This analysis highlight their strengths, challenges and growth opportunities in Malaysia dynamic telecom sector. Thank you.
Hi, I'm Maithili Saravanan with the matrix number of A23A1858. Today I'm here to present about the entity background of Celcom Digi Berhad. Firstly, regarding the vision is to be the nation's top telco tech company. Then, for the mission is to ensure customers stay connected through high quality mobile, data, and broadband service. Then, moving on to the main activities. The activities that provided by Celcom Digi Berhad is voice under their prepaid plans and postpaid plans, SMS, data plans and service, international roaming, international calling card, and WAP services. There are five major shareholders for Celcom Digi Berhad. Firstly is Axiata Group Berhad, then Citigroup nominees are Singh Sandian Berhad Telenor Malaysia, Amanat Trustee Berhad, Kumpulan Wang Persaraan which is known as KWSP, and Lembaga Tabung Haji.
Hi and Assalamualaikum. My name is Nur Izzati binti Mazan and my matric number is A23A2451. Today, I will present an analysis of key financial ratios for the years 2022 and 2023. This ratio helps us evaluate the company's performance across profitability, efficiency, liquidity, and leverage. First, let's begin with the ROCE, which is return on capital employed. In 2022, the ROCE was 4.55% and in 2023, it improved to 7.52%. Next, we move to the net profit margin. The net profit margin increased from 12.52% in 2022 and to 12.36% in 2023. Next, asset turnover. Asset turnover decreased slightly from 0.18 in 2022 to 0.17 in 2023. Next, we move to the return on equity, which is ROE. The return on equity showed a positive trend, increasing from 5.17% in 2022 to 9.52% in 2023. Next, we move to another ratio, which is return on total asset. Similarly, the return on total asset improved from 2.23% in 2022 to 4.3% in 2023. The interest cover ratio remains strong at negative 4.71 times in 2022 and negative 3.47 times in 2023. Next, dividend yield. Dividend yield increased from 3% in 2022 to 3.24% in 2023. Current ratio declined from 0.46 in 2022 to 0.46 in 2023. Next, I will analyzing the financial performance of our group and company through various key financial ratios. Let's start with the return on capital employed or ROCE. For the group, ROCE stand at 7.52%. For the company, the ROCE is slightly higher at 8.14%. The group's net profit margin is 12.36%. The company show a significantly higher net profit margin at 92.63%. Now, let's look at the asset turnover. For the group, the asset turnover is 0.35 times, meaning it generates around 35 cents for every 1 ringgit of asset. In contrast, the company has a lower asset turnover of 0.09 times. Moving on to return on equity or ROE, the group's ROE is 9.52%, while the company's ROE is very similar at 9.51%. The return on total assets for the group it is 4.3% and for the company it is higher at 8.30%. The group interest cover is 3.47 times, indicating it earned 3.7 times more than its interest expense. The company interest cover is higher at 12.82 times. Both the group and company have a dividend yield of 3.24%. With the group's current ratio is 0.46, while the company's current ratio is extremely low at 0.0045. Finally, the quick ratio. The group's quick ratio is 0.43, while the company's quick ratio is also 0.0045. Next, I will compare the financial performance of two companies, which is CelcomDigi and Maxis, using key financial ratios. Let's begin with the ROCE, or Return on Capital Employed. CelcomDigi's ROCE is 7.52%. Maxis has a slightly higher ROCE of 8.32%. Next, we have the net profit margin. CelcomDigi has a net profit margin of 12.36%. Maxis shows a net profit margin of 9.74%. The asset turnover ratio for CelcomDigi, the asset turnover is 0.35 times, while for Maxis it's slightly lower at 0.45 times. Return on equity measure the profitability relative to shareholder equity. CelcomDigi's ROE is 9.52%, while Maxis show a higher ROE of 70.74%. CelcomDigi's return on total asset is 4.3%, and Maxis has slightly higher ratio at 4.35%. CelcomDigi has an interest cover of 3.47 times, while Maxis has an interest cover of 3.05 times. Dividend yield is 2.34%, and Maxis has a slightly higher yield of 3.84%. CelcomDigi's current ratio is 0.46 and Maxis is 0.5609. CelcomDigi has a...
Assalamualaikum and hi, my name is Cik Nukrat Aini binti Cik Arifin. My metric number is A23B1425. Now I will present about interpretation calculation from the previous slide. There are three parts, which is comparison over two periods of CelcomDigi 2023, B, comparison between group and parent of CelcomDigi 2023, C, comparison between CelcomDigi and Maxis, which are both of them in 2023. For the comparison between two periods, 2022 and 2023 of CelcomDigi, ROCE year 2020 is 4.55%, while ROCE year 2023 is 7.52%. We see a noticeable improvement in the company's return on capital. This improvement of 2.97 signifies better management of capital and enhanced profitability, suggesting that CelcomDigi has become more efficient in utilizing its capital to generate earnings. Next, net profit margin from year 2020, 12.52% to 12.36% has been deteriorated of 0.16 percentage points. This decline in profitability indicates that they may be facing challenges in maintaining cost efficiency or controlling expense despite revenue growth. Comparing the asset turnover ratios of year 2022 is 0.18 times and year 2023 is 0.35 times. The company experienced a significant improvement of 0.17, indicating a notable increase in efficiency. Between the return on equity of year 2022 is 5.17 and return on equity of year 2023 is 9.52%. There is a 4.35% improved, signifying a considerable improvement. Comparing the return on total asset of 2022 is 2.23%, while return on total asset of 2023 is 4.3%. There is a 2.07 percentage point increase, indicating improved efficiency in utilizing assets to generate profit. Next is interest cover ratios of year 2022, 4.71 times, and year 2023, 3.47 times. There is a deteriorated of 1.24 times, indicating a reduced ability to meet interest obligations from earnings. In 2022, the dividend yield was 3.05%, while in 2023, it was 3.24%. There is a 0.19 percentage point improvement, reflecting a higher return for shareholders. This slight increase indicates that CelcomDigi has provided better income to its investor through dividends, which could enhance investor confidence. The current ratio remained constant at 0.46 in both 2022 and 2023. The stability indicates that the company has maintained the same level of short-term liquidity over two periods. However, a current ratio below 1 suggests that CelcomDigi may still face challenges. Last but not least, the quick ratio deteriorated slightly from 0.44 in 2022 to 0.43 in 2023, representing a marginal decline of 0.01. This minor reduction suggests that the company's ability to meet short-term liabilities without relying on inventory has slightly weakened, though the overall impact is minimal. The second part is comparison between group and parent of CelcomDigi in 2023. The ROCE of the group 2023 is 7.52%, while the parent company's ROCE is 8.14%. This shows that the parent company is more efficient in utilizing in capital to generate profits compared to the group as a whole. Comparing the net profit margin between the group and the parent company, the group's margin for 2023 is 12.36%, while the parent company's margin is significantly higher at 92.60%. The parent company's exceptionally high net profit margin suggests that it has a much stronger profitability position, likely benefiting from lower operating costs, a more efficient business model, or perhaps higher margin revenue streams. Next is the group's 2023 asset turnover ratio is 0.35 times compared to the parent company, although the parent company ratio is considerably lower at 0.09 times. Comparing the return on equity between the group parent and the parent company, the group's return on equity for 2023 is 9.52%, while the parent's return on equity is slightly lower at 9.51%. The close alignment between the group and the parent's ROE suggests that both the parent company and the group as a whole are similarly effective at generating returns for shareholders. In comparison to the parent company, the return on total asset for 2023 is 4.30%, whereas the parent's return on total asset is 8.13%, which is a substantial difference. The parent company's higher ROTA indicates that it is more efficient at generating profit from its total asset compared to the group as a whole. This suggests that the parent may be leveraging its asset more effectively, possibly due to a more streamlined or focused business operation. When the group's 2023 interest cover ratio is compared to the parent company's, it is 3.47 times, but the parent company's ratio is 12.82 times. The parent company's much higher interest cover ratio indicates that it has a stronger ability to meet its interest obligations from its operating profit, suggesting a more robust financial position and lower financial risks. The dividend yield for both the group and the parent have the same dividend yield for 2023 at 3.24%. This indicates that the group and the parent are offering an equivalent return to their shareholders through dividends. Next, the current ratio for the group's ratio for 2023 is 0.46, while the parent's ratio is much lower at 0.0045. The group's current ratio of 0.46 indicates that it has sufficient assets to cover its short-term liabilities, suggesting a healthy liquidity position and low risk of liquidity issues. Comparing the quick ratio between the group and the parent company, the group's ratio for 2023 is 0.43, while the parent's ratio is again extremely low at 0.0045. The group's quick ratio of 0.43 indicates that it has a solid ability to meet its short-term liabilities without relying on inventory. This suggests that the group is in a strong liquidity position with the sufficient liquidity assets to cover its immediate obligations. For the last part, comparison between the CelcomDigi and Maxis. In terms of ROCE, Maxis has a substantially better ROCE than CelcomDigi, which has a ROCE of 7.52%, while CelcomDigi's ROCE is 8.32%. This suggests that Maxis is more efficient in generating profits from its capital base compared to CelcomDigi. The net profit margin of CelcomDigi 7.52% and Maxis 8.32%. CelcomDigi shows a higher profitability with a difference of 0.8 percentage points. This indicates that the CelcomDigi is more effective at converting revenue into net profit, which may be attributed to better cost control or higher operational efficiency. Comparing the asset turnover ratio of CelcomDigi 0.35 times and Maxis 0.45 times, Maxis demonstrates a higher efficiency in utilizing its asset to generate revenue. The difference indicates that the Maxis generates more revenue per unit of asset compared to CelcomDigi. This suggests that Maxis may have a more optimized asset base or more efficient operations, driving its sales. Comparing the return on equity of CelcomDigi is 9.52% and Maxis is 17.27%. Maxis shows a substantially higher return to its shareholder. The difference of 7.75 percentage points indicates that Maxis is more effective at generating profit from shareholders' equity. This could be due to higher profitability or better financial leverage. In comparison, the return on total asset of CelcomDigi is 4.30% and Maxis is 3.05%. Maxis' return on total asset of 3.05% is lower, meaning Maxis is less efficient in generating profits from its total assets. The difference in these ratios suggests that CelcomDigi is performing better than Maxis in terms of asset utilization and profit generation, indicating a more efficient use of its resources. When comparing CelcomDigi's 3.47 times with Maxis' 4 times interest cover ratios, Maxis demonstrates a slightly stronger ability to meet its interest obligations from operating profit. The difference, although small, indicates that Maxis has a marginally better financial cushion to handle its interest expenses, which reduced financial risk compared to CelcomDigi. The dividend yield of CelcomDigi 3.24%, meanwhile Maxis 3.84%. Maxis offer a higher return to its shareholder in the form of dividends. The difference of 0.60 percentage points suggests that Maxis is more generous in distributing profit to its investors, potentially making it a more attractive option for income-focused shareholders. Comparing the current ratio of CelcomDigi 0.46 and Maxis 0.5609, CelcomDigi's current ratio of 0.46 indicates that the company has fewer current assets than current liabilities, which suggests some liquidity concerns. While it is not in immediate danger, CelcomDigi may face challenges in meeting short-term obligations. A comparison between Maxis 0.43 and CelcomDigi's 0.5568 quick ratios, Maxis' quick ratio of 0.5568 is higher, indicating a better liquidity position than CelcomDigi, although still below the ideal threshold of 1. Maxis is in a relatively stronger position to meet its short-term liabilities without depending on inventory or non-liquid assets. That's all from me. Thank you.
Assalamualaikum warahmatullahi wabarakatuh. My name is Nur Akila Omar and my matrix number is 8238247. So today I will present about analysis of performance and position of the entity between CelcomDigi and Maxis. So here are comparison of a two period of CelcomDigi on 2023. So we will start with the ratio of return of capital employed, or we call it as ROCE. ROCE measure how efficiency a company use its capital to generate profit. So the significant improvement from 4.55% in 2022 to 7.52% in 2023 indicates a notable increase in capital efficiency. So this suggests that CelcomDigi has become more effective in generating profit relative to capital employed. So second ratio is a net profit margin. So the net profit margin has slightly decreased from 12.52% in 2022 and 12.36% in 2023. So this small decline may indicate a marginal reduction in profitability possible due to higher expenses or reduced revenue growth to the overall margin to remain strong. So the third ratio is turnover. So asset turnover has significantly improved from 0.18 times in 2022 and 0.35 times in 2023. So this indicates that CelcomDigi has been able to generate more revenue from its asset, reflecting a higher efficiency in asset utilization. Next is the return on equity, ROE. So ROE has more than doubled, improving from 5.17% in 2022 and to 9.52% in 2023. So this shows that the company is delivering better returns to its shareholder, reflecting improved by profitability and capital utilization. Then for return on asset, ROTA, ROTA has increased significantly from 2.23% to 4.30%. So this indicates that CelcomDigi is generating more profit per dollar of asset, 2.23%, signaling improved efficiency in utilizing its total asset base. Besides, for the interest cover has decreased from 4.71 times to 3.47 times, while it's still above 3 times, which is generally considered safe. This decline suggests that CelcomDigi's ability to cover the interest expenses with operating profit that has slightly weakened, possibly due to increased financial costs or lower the operating income. Also, for the dividend yield has slightly increased from 3.05% to 3.24%. So this shows that CelcomDigi has slightly increased its dividend relative to its stock price, which could indicate the company's strong cash position and the commitment to returning value to the shareholder. So the net is current ratio remain unchanged at 0.46. So this below the deal threshold of 1.0, indicating that CelcomDigi may face liquidity challenge and might be not to cover its short-term liability with a current asset. So the company might be rely on other financing mechanism to manage short-term obligation. So lastly is the quick ratio, which is similar to the current ratio but exclude inventory, has remained relatively stable. So decreasing slightly from 0.44 to 0.43. This further suggests limit ability to meet a short-term obligation without relying on inventory or external financing. So here we will continue for comparison between group and parents of CelcomDigi 2023. So for return on capital employed (ROCE), the parent company has slightly higher ROCE for 8.14% compared to the group 7.52%. So this suggests that the parent is more efficient at generating profit from its capital compared to the overall group, which could be due to the different structure or operation within the group. So the next ratio is the net profit margin. So the parents have exceptionally high net profit margin of 92.60%, which is significantly higher than groups for 12.36%. So this discrepancy likely arises from a significant difference in revenue or cost structure between the parents and the subsidiary. So the parent company may have a minimal operation cost or revenue derived from the specific non-operating activities such as interest income or asset sales. Then for the asset turnover, the group have a significantly higher asset turnover for 0.35 times compared to the parents 0.09 times. So this suggests that the group is more effective in generating revenue from its asset. So the parents' low asset turnover could indicate that it's holding a significant asset that not directly contributing for the revenue generation, possibly due to the non-operational asset or investment. So for return on equity (ROE), the ROE is nearly identical for both the group and the parents, 9.52% and 9.51%. So that's showing that the both entities are delivering nearly the same return to their shareholder. So this reflects the stable and the similar profitability for the equity holders in both the group and the parents companies. So next for the return on asset, or we call it as ROTE. So the parents has much higher return in total asset for 8.13% compared to the group 4.30%. So this suggests that the parents is more efficiency utilizing its asset to generate the profit. So the group, possibly due to its larger size and diversified operation, so they may have a lower asset efficiency. So for the interest cover, the parents' interest cover 12.82 times is significantly higher than the group, 3.47 times, indicating that the parent is in a much stronger position to cover its interest expenses from its operating profit. So the group, while still able to cover its interest payment, so it's more vulnerable to fluctuation in operating income. Besides, for the dividend yield, they have the same dividend yield of the 3.24%. So this suggests that the both entities are equally committed to providing shareholder return through the dividend, maintaining their consistent in their dividend policies. Then for the next current ratio, so the current ratio of the parents is extremely low, much more lower than the group. So this indicates that the parents company that has severe liquidity issues likely to struggle to cover the short-term liability with the current asset. So the group, although it's below the ideal 1.0, but it's slightly better for the liquidity position than the parents. And lastly, for the quick ratio, so it's mirrored to the current ratio of the parents, that suggesting that they have the significant liquidity crisis. So for the group ratio, they've got 0.43, which is indicate the limited ability to meet the short-term obligation without relying on the inventory or external financings, but it's still in a somewhat better position compared with the parents. Lastly, we will see the comparison between Celcom DG for 2023 and Maxis for 2023. So first is return on capital employed. So here we can see that Maxis has a higher ROCE, 8.32% compared to the Celcom DG 7.52%, indicating that Maxis is more efficient in using its capital to generate the profit. So Maxis is likely better at utilizing and its invested capital to create value for shareholder. Next is net profit margin. So it shows that Celcom DG has a higher net profit margin compared to the Maxis. So this suggests that Celcom DG is more efficient at converting revenue into actual profit, possibly due to the lower cost. So then for better pricing strategy or more efficient operation in its business segment. Next, for asset turnover, so Maxis has a higher asset turnover than compared to Celcom DG, which is revenue from its asset. So Maxis is better at utilizing its asset base to produce sales, indicating higher efficiency in asset management. So for return on equity, so here we can see that Maxis has a significantly higher ROE, 17.27% compared to the Celcom DG 9.52%. So this indicates that Maxis is delivering far higher return to its shareholder, suggesting more effective utilization of equity capital and potentially a more favorable financial structure. So next, we will move to return on total asset. So Maxis has a slight higher return on asset at 4.35%, compared to the CelcomDigi 4.3%. So this shows that Maxis is more efficient at generating profit from its total asset, meaning that Maxis is utilizing its entire asset base more effectively than CelcomDigi. Then for the interest cover, so CelcomDigi has a slightly better interest cover ratio for 3.47 times compared to the Maxis 3.05 times. So while both companies are able to cover their interest payment comfortably, CelcomDigi shows that they have a stronger ability to meet its debt obligation through the operational profit, suggesting a lower financial risk. For dividend yield, so it shows that Maxis has a higher dividend yield compared to the CelcomDigi's, indicating that Maxis provide a higher return to the shareholder in the form of dividends. So this might make Maxis more attractive to income-focused investor. Not forgotten, so for current ratio, CelcomDigi, so it shows that Maxis have a better current ratio than the CelcomDigi, but both ratio are still below from the ideal level of 1.0. So this suggests that the both company may face some liquidity challenge, but Maxis is a marginally better position to meet the short-term obligation using its current asset. And also, last but not least, for the quick ratio, so outperforms CelcomDigi on the quick ratio, which is exclude the inventory from the calculation. So this further emphasize Maxis slightly stronger liquidity position, although the both companies still face some liquidity risk with the ratio below 1.0. Thank you.
Assalamualaikum warahmatullahi wabarakatuh. My name is Nuri Ilana binti Muhammad Dahari and my matric number is A23B1356. So, I will present about the conclusion of the analysis of CelcomDigi Berhad and Maxis Berhad. So, the conclusion is the financial analysis of CelcomDigi Berhad and Maxis Berhad in 2023 highlight key strengths and challenge for both companies. CelcomDigi has shown improvement in capital utilization, asset turnover and overall efficiency. However, despite revenue growth, it faced challenge in maintaining profit margin and liquidity. When compared to Maxis Berhad, CelcomDigi demonstrates strong asset utilization, but Maxis outperformed in return on equity, capital efficiency, and liquidity, making it financially stronger overall. And for the recommendation for CelcomDigi Berhad is to enhance its position. CelcomDigi should focus on improving liquidity management to ensure financial stability, implementing stronger cost control measures to sustain profitability, and optimizing capital efficiency to generate better return for shareholders. By addressing these key areas, CelcomDigi can strengthen its financial standing and remain competitive in the Malaysian telecommunication industry. So that's all from me, and that's all from us too. Thank you.